This is Asad Hamza from investone.com. I am here to show you how to trade forex market or any financial market using the naked trading, the price action trading strategies. This is the best strategy I have found for many years that is very profitable, and they have making a bunch of pipes using it. Uh, I think that you know that following trends is the best strategy you can ever find to trade the market. Never trade using indicators because indicators they just follow the price and they don't predict the price. So I think that trends predict the price the right way. So I'm here to show you how to trade it for life. And firstly, I want to show you what is price action trading. Trading trends is just it's not like scalping strategies, for example, scalping from the market. This is based on trends, following trends until just for example, this is for example the corn. We are going to follow the trend until it reverses its direction. For example, here there is a downtrend here, a little bit downtrend here, and we are going to follow it until it reverses in this point. So we're going to trade in this trend, this new trend. Uh, just keep it simple. The price action trading is to follow trends until it reverses its direction from an uptrend to a downtrend and vice versa. So uh, the price action trading have many advantages. So the first advantage that you are going to trade using the 4 hour time frame. It's going just to be good to trade using the 4 hour or the daily. So we are long-term traders because the price action trading is a long-term trading strategy. So you don't need to buy any indicator, any software. The prices have a clean view. If you look here, for example, for the naked trading, we trade without any indicator. So indicators are forbidden if you trade using the price action strategy. So if you trade using indicators, your chart will be looked like that. So there is Bollinger Bands indicator, there is moving averages, there is the momentum indicator, and many indicators that convert your the chart viewing as a MISI. So um, uh, trading with clean chart is very important, and the naked trading make you feel that this is very clean. So we are going to not use any indicator, no momentum indicator, no RSE, no market, no parabolic SAR, no any indicator. So we are trading naked. Um, for the strategy, you must firstly know what is a trend. So the trend is simply the general direction of the price. So usually the price moves in trends. They are controlled by traders' emotions. For example, if traders are fearful, the price will fall down, and if the traders are greedy, the price will go up. So this is about the psychology of traders. So the market is controlled by the psychology of traders simply. For example, here traders are very fearful, so the price will fall down, and here they are very greedy, so the price go up. Um, for there are three types of trends. There are long-term trends, intermediate trends, and short trends. And I advise you to trade the long-term trends, the trends that are touched by the price 3 times. For example, we are going to take this example. We are going to draw the trend here. Yes, I'm not familiar with the MetaTrader as well, but I will keep up with the situation. For example, we have a trend that is touched at least 2 times with the price. So the first peak is here and the next peak is here. So this is a valid trend and we can work with it to predict the market, but we are going to use some strategies, some advanced price action strategies to trade the market, and just keep viewing the video. Okay, so the trend must at least touch the price for 2 times to be a trend line, to be a valid trend line. So this is a downtrend. So we have a downtrend here, the price is falling down, and here we have an uptrend. I'm going to draw it. Yeah, it touches the price for 3 times. If the price touches the trend for 3 times, this is a strong trend and you must trade it because it's a strong trend. And if it is broken or breached by the price will go into reverse its direction, like you see here. So the price broke the trend here, it's broken, so the price falling down and reverse its direction from an uptrend to a downtrend. But we are not trading using this specific technique I show you now, but we're going to use swing highs and lows. So I have showed to you how to draw trends the perfect way. This is the perfect way to draw trends. We are going to show, I'm going to show you some other examples. For example, this is example, yeah, example. So we are going to draw the trend like there. This is a valid trend line. We have a falling down price and we have a downtrend here that touches the price at least 2 times. So this is a valid trend, and if the price is touched more than, if the trend is touched by the price more than 2 times, this is a very strong trend and you must trade it. And if it is broken, the price will reverse its direction aggressively. So the first thing to do is to distinguish can we distinguish the trend line breaks. If it is a reversal, we can trade it. If it is not, we cannot trade it if it is a consolidating trend. So for example, trend is a downtrend and we have a broken here, the trend line is broken here, so we have a new uptrend there. So we have a new uptrend here. I'm going to fix the problem. We have an uptrend. I don't know why. Okay, we create new ones. So this is the new uptrend. We have it like that. New uptrend. It must touches the price for at least 2 times. This is the downtrend. The downtrend, like you see here, the trend is broken like here by the price movements. So how we can know that this trend will reverse its direction or will consolidate the direction? So the price will not reverse its direction, but it will enter in a state of consolidation. So we are going to trade the reversal trend and not the consolidation trend. So the rule is simple. There is a general rule that you must know. The penetration of a trend line with a sharp angle is more likely to result in a consolidating than a reversal. So For example, I will give you this example because I don't find it right now in the market. So this is a sharp angle. A sharp angle is the angle that is uh, uh, minus than 90 degree. So like this, it's inferior of 90 degree. Like this is a sharp angle. We have an uptrend and we have a new little uptrend that constrict a sharp angle. So this is a consolidation, and we cannot say that the trend will reverse its direction from a downtrend to an uptrend. So you need, just as I have told you to do, is to draw the first trend, for example here, to draw the downtrend, and draw the new trend to know if there is a consolidation or not. For example here, if the price here, you feel that there is a reversal trend, you must draw the new trend to know if it is a consolidation one or a, a reversal trend. So this is very important to do. For example here, in this is example, we have so an uptrend, and there we have a broken trend line, and we'll be accepting a downward trend, so a reversal trend, but this is a consolidation state of the trend line of the price movements. And how we know that? How we are drawing the new trend line, and we have constated that there is a sharp angle constricted like there, and this is not a reversal trend line. The other example here, we have a reversal trend line. So the first trend line is this is one, and the reversal trend is this is one, and we have not a sharp angle. This is a plus 19 degree angle, and this is a reversal trend line. So the first thing to do is to define the measured trend you are going to trade. For example, here we are going to trade the 4-hour time frame. This is the sugar, and you can use it to trade the euro, any currency pair. There is no problem, and the price action trading is available for everything that moves. Really, it trades anything that moves. For example, here the sugar. So we are going to define the measured trend of the sugar. We are going to use the indicator moving averages. So we are going not to use it to trade the market, but just to define the measured trend we are going to trade. So here we click trend, the moving averages 200. We define the 200 moving average trend. Click OK, and here we have a downward trend, a downward measured trend here. So the moving average is above the price, so the measured trend is a downward one. If the moving averages is below the price, like there, so the measured trend here is an uptrend. And okay, this is how to define the measured trend. Here, like I told you about previously, this is a downtrend, and here you must enter for short positions. You must sell the market. If you buy the market, if you enter for long positions, it will be an unforgiven mistake from you. And if you find that the daily time frame displays that the 200 moving averages is above the price, so the price is falling down, and the measured trend is a downtrend. For example, here we have a downtrend, like I told you about. So the first thing to know about the strategy is to know to distinguish between the impulsive move and the corrections. For example, here we have an impulsive move followed by a correction and another impulsive move followed by a little bit correction and an impulsive move and a new correction, an impulsive move, and like that is going on. So just distinguish between the impulsive move and the correction. The impulsive move is in the direction of the trend line. So here we have an uptrend and the impulsive move is in the direction of the uptrend. So the correction is in the, the, the opposite direction of the trend. Here is a down, 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 and here it's the impulsive move is up, 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 up. Okay, so the first thing about price action trading is to define the higher higher and higher lower in an uptrend, and to define the lower higher and lower lower swing highs and lows in a downtrend. So here the rules are very simple. So if you are in an uptrend, the higher higher is here and the higher lower is here. The next higher higher is confirmed by a huge impulsive move here. The huge impulsive move surpass the first higher higher to be validated. So this is the first higher higher, higher lower, and I recommend you to use the zigzag indicator. You could find it here. Zigzag indicator, yes, is there in the examples. Zigzag. The zigzag will help you to define the higher higher and the higher lower. So we define the first the first higher higher and higher lower, and this is higher higher will going to be validated if the price goes for an impulsive move like there, for an impulsive move that surpass this is higher higher. So this is the correction between the higher higher and the higher lower, the correction in the opposite direction of the trend we have. This is the new higher higher and the new higher lower, and to be validated it must have the price must have an impulsive move in the direction of the trend that surpass this is higher higher. So this is an impulsive move that surpass the higher higher. So we are going to define the next higher higher and higher lower and higher higher and higher lower. So this is the first thing to do if you have an uptrend and you want to trade for short positions. You want to find, if you want to find new short trading opportunities. So this is another example for a downtrend, and if you want to go for long positions, so this is the lower lower and the lower higher, and this is lower lower is confirmed by an impulsive move in the major direction of the trend. Here we have a downtrend and the lower lower is confirmed by this is impulsive move. After that we have a correction here and another impulsive move that confirms this is lower lower and another lower higher that is confirmed by a new impulsive move. So, and it's going on. So here is an example. We have here a downtrend and we have here a correction. This is correction, makes new highs and lows, and this is we can tell that this is a strong trend because the correction creates new highs and lows. This is the thing you want to know, that the trend maybe there is a 90% probability that the trend will continue its direction in the direction of the trend line if a correction creates new highs and lows, new small highs and lows. So now you have defined the measured trend, and you know how what is an impulsive move and a correction. You know how to define the higher higher and the higher lower, and you know how to define the lower lower and the lower higher. And this is the tools you need to trade the market. So for this is example, for example, we have a higher 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 lower higher 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 lower, and the next higher 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 lower. Here is where we are going to enter the market. When the price reached the last higher lower for an uptrend, there is a huge probability that the price will reverse its direction to a downtrend until it touches the first higher lower. So as you look here, if you are right here, you define the higher swing highs and lows, and the last higher lower is broken by the market, and the price go down and make a huge correction, but it continues its direction to a downtrend and touches the last higher lower here. So we are going to make all of these pips easily, but pay attention to the measured trend. It must be a down measured trend to drive that. But if it isn't, maybe it will continue its direction to an uptrend and you will fail your trade here. So I'm going to show you some other examples. Here we have a higher higher, a higher lower, and we have a correction, a new impulsive move in the direction of the trend. We have here a correction. We have here the last higher lower is broken by the market, and the trend reverses its direction in the opposite direction of the trend line and makes new lower lowers and lower highs. So this is the correction, and this is the last higher lower is breached by the price movements. This is the correction, also correction. um, uh, so it's going on like here. There is a potential lower lower, like you see here. This is a potential lower lower, but it is not confirmed by an impulsive move. Like you see here, the price goes up and goes down quickly, not like this is lower lower that have a new correction and an impulsive move that confirms this is lower lower. So if you are in this situation, you must define the next bottom as the new lower lower. This is also a potential lower lower, but we haven't really an impulsive down move that confirms this is lower higher. So we're going not to consider this as a lower high, but generally you can define that just using the zigzag indicator, as I show you previously. This is the zigzag indicator, and you can find the swing highs and lows easily, like you see here. Let's do some live trades. Like you see here, we have a lower lower, a lower higher, a lower lower, a lower higher, and the final lower higher is broken by the market. Like you see here, the final lower higher is broken by the market, and the price goes up. But this is the daily time frame, but the weekly must confirms our decision. For example, here we're going to define we're going to add the moving averages 2000, and we have a major uptrend here. So we could enter for, yeah, oops, we have here, yes, a lower lower, a lower higher, lower lower, lower higher, and here the price is broken by the market. I think that the price will continue its direction to this resistance here. So we are going to make all of those pips. I think that are maybe 20 pips. Yes, approximately 20 pips. Okay, I recommend you to not trade regularly the commodities markets using this strategy like corn, sugar, because it's not really volatile like the forex market. The forex market is very volatile, and you must trade the major currencies, the major pair of currencies like the euro, USD, like the GBP, like the GPY, GPY, Japanese yen, like the Catholic franc. So this is simple, just do not complicate the process. So here is, for example, the potential higher, but this is potential higher is not confirmed by a huge impulsive move. So as so for example, this is higher is confirmed by this is impulsive move that goes in the direction of the trend. So like this is higher and higher lower, they are not, this is higher is not confirmed by an impulsive move in the direction of the market. So here we can expect a downward trend that is coming, and this is what happened. The trend reverses its direction after the final higher lower is broken by the market, because the price fell to to create new higher and higher lowers, and begin to create new lower and higher, a new lower and lower higher swings. So this is an impulsive move. This is the correction, correction. Okay, there is a rule that you must consider here. For example, this is the correction we have, this is the impulsive move, and we have a downward trend. The correction is 527 pips, and the impulsive move is slightly 2200 pips. This is the impulsive move, it's for 922 pips, and the correction is 527 pips. So just what I want to tell you here is to consider a move that it is an impulsive move. It must at least be one for 2 times the correction move. If you take the correction move and you multiply it for 2 times, you must find the impulsive move equal the impulsive move. So 2 multiplied by the correction must equal the impulsive move. So this is the rule you must consider to consider a move that it is an impulsive move. Like you see here, this is a strong impulsive move because the correction multiplied for 2 is equal the impulsive move. So the strategy is very simple. You must just define the major trend line, define the higher and higher lows if you are in an uptrend, define the lower highs and lower lows if you are in a downtrend, then look for a final higher lower to be broken by the price movements. Then enter the market here you must enter the market here, and then exit the market if the first higher lower is broken by the price. And here just enter the market also if the high lower is broken for a downward trend. If the last lower higher is broken by the market, just enter the market here and exit the market once you see that the price will against reverse the direction. How we could know that? I just generally target last lower higher, the first lower higher, sorry, or I draw a Fibonacci level here and target the 61% level. This is simple. Just you are going to, for example, here if you are in downtrend and you are like there, and just target this is level of Fibonacci and exit the trade, or just like you see here, just target the first lower higher here, and the price will goes to the last lower higher. Why the price is not going here? Just because the major trend, I think that here the major trend is not an uptrend, and this is a huge mistake to enter against the major trend. Here the major trend is a downward trend, so you must look for this is reversal, not this is a reversal trend. This is all I want to show you, and I hope you benefit from this. And if you have any question, just comment below the video, and I will answer you. This is Hamza Asad from investone.com. If you want to visit my website, this is my website. Sign up for my newsletter to get new insights about forex trading and all the financial markets. Thank you very much, and if you have any question, just put them below. Have a good day, and thank you.